It's the big boom and bust and build up in debts that happens over generations. And it's that big unwind, the secular unwind, the debt deflation that is an interesting part to us, or the big boom. So again, we can talk about
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. Recent discussions have seen Raoul Pal, CEO of Real Vision, emphasize a significant concern pertaining to the global financial system, especially in the aftermath of the 2008 financial crisis. Globally, governments have predominantly utilized currency debasement as a tactic to circumvent complete financial failure. This entails the strategy of increasing the money supply to address and accommodate rising national debt levels. This strategy may provide a momentary relief. However, it is essentially a temporary solution that carries considerable long-term consequences. The fundamental issue is the disparity between increasing debt levels and the corresponding economic growth. Even with the infusion of liquidity by governments into the economy, the growth rates have failed to align with the rising levels of debt. As a result, wage growth has remained flat, resulting in a considerable segment of the population struggling to manage their living costs, which encompass mortgage obligations and credit card liabilities. This scenario presents a delicate imbalance that poses a risk to the overall stability of the financial system. The stagnation of wages in relation to inflation and escalating debt levels is resulting in a decline in consumer purchasing power. The absence of income growth hampers economic activity, resulting in stagnation. Failure to meet financial obligations can initiate a series of defaults, potentially destabilizing the banking system and worsening economic downturns. Furthermore, this pattern of postponing the unavoidable downturn via monetary policy can be interpreted as a strategy of delaying the inevitable. Policymakers might be inclined to persist with this approach, anticipating that economic growth will ultimately align with the existing debt levels. Nonetheless, the extended duration of this imbalance heightens the risk associated with the situation. Raoul underscores the importance of this issue, indicating that it warrants attention from both investors and the general public. Disregarding these indicators may result in a substantial fiscal consequence. The ongoing increase in debt, coupled with stagnant economic productivity and wage growth, heightens the potential for a systemic crisis. He emphasizes the importance of tackling these fundamental issues instead of depending on temporary solutions. This necessitates a thorough reassessment of economic policies, emphasizing sustainable growth strategies that prioritize job creation and wage enhancements. Implementing this strategy could potentially facilitate the realignment of the economy, fostering a more stable financial landscape moving forward. Raoul Pal's insights highlight the delicate nature of our financial systems. The ongoing dependence on currency devaluation and the expansion of the money supply is not a viable long-term strategy. In the absence of strategic interventions aimed at fostering authentic economic expansion and tackling the issue of wage stagnation, the potential risk of economic downturn continues to be a significant concern. It is crucial for all parties involved, policymakers, investors, and the general public, to heed these warnings and participate in substantive dialogues regarding the trajectory of our economy. And lots of things Raoul Pal discusses, so please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
I know that sounds a bit complicated, but basically it gives you the equity cycle. You can see from the chart, equities are very cyclical when we look at it in those terms. We know that once they've peaked, we're going to get declining returns of equities going forwards for the best part of a decade or longer. We saw the very sharp fall that we had from the 2000 high going down into the low back in 2009. However, it's bounced back up again, and I'm not entirely convinced that this market cycle is over because the time is very short versus previous cycles. So that tells me that this is probably a shadow bounce in terms of returns, and likely going forward is a process of more low returns coming out of stock markets, and I think that will mean negative returns to come. And I think the final bottom of the cycle will play out maybe in the next 5 years, which will be basically in line with the other cycles. And that's some of the important things to know. What we're looking again is probability. The probability is that we think it will hook back down again, much like it did in the mid-30s, you can see on the chart. So if that's the case, then it's going to come back down to the low levels that we saw before. Any cross below about 5% on this chart means we get some really nasty surprises in a terrible economy. Knowing the global imbalances that we've got, the chances are still high that that's the case because those imbalances haven't been cleared. All of the other market troughs, we saw very low market valuations and low debt levels. We haven't got to that clearing point yet. So I think that's to come. And again, this probability allows us to understand when this is likely to happen because we understand that there's a certain length to the cycle. So if we think the cycle now is rather short, we know that there is a period of time for which we should be expecting the bottom. It gives us a probability that the bottom is still yet to come. And that's how we need to think about things. So now we can understand demographics and how they drive things. We can also understand the equity market cycle. So the next thing we need to, and that's probably driven by demographics partly, to be fair. The next part we need to look at is the commodity cycle. Commodity cycle is one of the oldest cycles of all. So the chart you're looking at now is the overall commodities GMI composite supercycle. It's a long name, but basically it's a mix of a whole load of commodities. And then we look at the 10-year on 10-year moving average. And again, you can see it's very cyclical. Now, what it tells us is the cycle has not bottomed yet, that this is the global commodity supercycle bust that I've talked about on Real Vision and many of the other guests have. We know that that bust takes a certain period of time to get to, and we know that commodity returns stay around zero on a 10-year on 10-year basis for an extended period of time. Those bottoms last maybe a decade. So we've got a long period ahead of both falling returns from commodities and then a whole period of stagnant or low returns from commodities. Many of you remember the final part of that in the late 90s before gold and oil and all those other commodities took off. That was the final part of the commodity supercycle bust. That all lies ahead. So I really can't be bullish about commodities in a meaningful long-term way for a long period of time. That doesn't mean that precious metals or cannot outperform, because I know many of you are interested in precious metals. It does mean, however, that generally the commodity complex, and I'm meaning mainly the industrials and potentially also the agriculturals, don't tend to do well.
On September 13th, Bitcoin effectively regained the $60,000 threshold, indicating a strong rebound driven by optimistic investors. In the last week, Bitcoin has demonstrated a significant upward movement, increasing by around 10%, effectively reversing the previously unfavorable returns of September into a positive trend. With the Federal Open Market Committee, FOMC, meeting set for September 18th, market participants are meticulously evaluating possible scenarios. The CME Group's FedWatch tool indicates a 50% likelihood of the Federal Reserve executing a 50 basis point rate reduction. Should the Federal Reserve choose to implement a more conservative 25 basis point cut, we may observe an immediate response in the cryptocurrency markets, which could result in downward price movements for Bitcoin and various other digital assets. In light of the recent fluctuations, it is important to note that the overarching sentiment among institutional investors continues to lean positively in the long term. MicroStrategy, a leading entity in the business intelligence and software sector, reported the acquisition of 18,300 Bitcoin from August 6th to September 12th, with an average purchase price of around $6,450 per Bitcoin, inclusive of related costs and fees. The recent acquisition has increased the firm's total Bitcoin holdings to approximately 244,800, with an average acquisition cost of roughly $38,585. The critical consideration at this juncture is Bitcoin's ability to sustain its valuation above $60,000, which could potentially stimulate additional buying activity. The prevailing optimism about Bitcoin's price trajectory is significantly shaped by macroeconomic factors, especially the anticipated actions of the Federal Reserve concerning interest rates. The upcoming FOMC meeting on September 18th holds considerable importance, as it could represent a crucial turning point in monetary policy, with officials possibly reducing interest rates from their peak levels in almost 25 years. QCP Capital has indicated that it is strategizing for multiple scenarios related to risk assets and cryptocurrencies ahead of the forthcoming Federal Reserve meeting. Despite recognizing short-term volatility and the possibility of declines, QCP Capital maintains a positive outlook, prioritizing strategies that secure yields in anticipation of the expected rate reduction. This strategy seeks to leverage optimistic market conditions as the financial landscape evolves with the implementation of new monetary policies. The recent performance of Bitcoin, coupled with substantial institutional acquisitions and evolving macroeconomic factors, indicates a multifaceted yet potentially lucrative environment for investors. With the cryptocurrency markets anticipating the FOMC's decision, the relationship between monetary policy and digital asset valuations will play a pivotal role in shaping the forthcoming market dynamics. It is essential for stakeholders to stay alert and well-informed as these developments progress, as they may significantly impact both Bitcoin and the wider cryptocurrency landscape. Let's back to the Raoul Pal interview.
And it's that big unwind, the secular unwind, the debt deflation that is an interesting part to us, or the big boom. So again, we can talk about countries like India, or countries in the Middle East, or countries around the Indian Ocean that have very low debts and a good demographic. We would therefore imagine that over time, that young population will borrow money with which to buy houses and cars, and the debt supercycle begins. And that will run for several decades until a point where the debt becomes unsustainable. Countries will ebb and flow within that, and some will have a debt supercycle that runs too quickly. Egypt, for example, had it recently. They had too much housing build. We've seen that in the Middle East somewhat in various places. But other countries don't have too much debt issues, but over time they will. But again, when we flip back to the West, we can see, or we understand, that there's huge debt problems. The US alone, if we look at total debt to GDP, to world GDP, is the most indebted country as a percentage of world GDP of any country in history. Also, the world is currently about 350% debt to GDP, which is the highest ever recorded in the world. So we have a massive debt supercycle underway. We know the rate of change of debt buildup is now falling. That rate of change is the peaking out of the cycle, and then we've got the overall bust to come. The overall bust has to be when debts get written off, inflated against, or devalued against, but that debt has to go, and it can take a long period of time. The chart I've decided to use to illustrate this point is the US total debt as a percentage of GDP, which I referred to earlier, but the 10-year on 10-year percentage movement. Now, what you can see again is it's cyclical. We had a huge build-up in debt in the early 80s, and that debt has over time been slowing, and we can see the big rate of change, which I was talking about, the importance of the rate of change happening now. We've got an enormous falling off in the rate of change of debt buildup, and that generally indicates to you that the debt supercycle bust is underway, and that process will take decades, if not longer, to sort themselves out. We don't know how it's going to finish, whether it happens in a big shock, and I've talked about the reset before. I've also talked about a debt jubilee, which is debt forgiveness. These are maybe the ways we do it. We don't know. Maybe there's a hyperinflation or inflation out of debt. But over time, debt burdens are unsustainable. And I know many people, particularly in the Keynesian camp, will say, you know what, we can run debt burdens forever. We'll just finance them by printing of money. Well, in the end, that doesn't work, because something lets that debt unwind, because what happens is the massive amounts of debt causes a fall in the velocity of money. And therefore, any increase in debt or quantitative easing or any form like that has limited impacts.
The recent price fluctuations of Bitcoin suggest a potential alignment of technical indicators that could point to an upcoming breakout. A notable pattern identified on the charts is the cup and handle, a respected technical formation that generally indicates a bullish continuation trend. The cup and handle pattern is characterized by two primary elements: the rounded bottom of the cup and the following consolidation phase referred to as the handle. In the context of Bitcoin, the cup formation initiated after reaching its peak in late 2021. The cryptocurrency has been fluctuating beneath the resistance threshold of $65,000 to $69,000, indicating that the handle is currently forming. The current phase of consolidation frequently serves as an indicator for a significant bullish breakout ahead. A breakout from the cup and handle pattern is identified when the price exceeds the neckline resistance level. Based on the principles of technical analysis, the anticipated upward movement typically corresponds to the maximum distance measured from the neckline to the lowest point of the cup. In the analysis of Bitcoin, the lowest point of the cup formation is projected to be approximately $115,000, whereas the resistance level at the rim is identified around $65,000. The resulting distance is estimated to be around $50,000. Independent analyst Elia has projected a target range for Bitcoin, estimating it could reach approximately $110,000 to $130,000, potentially by early 2025, based on the upward distance from the breakout point. This forecast is contingent upon the premise that the price will surpass the defined resistance and sustain the momentum required to achieve these target levels. It is essential for market participants to closely monitor the forthcoming trading sessions as the price nears the resistance range of $65,000 to $69,000. A definitive breakout above this range may validate the cup and handle pattern, potentially paving the way for substantial upward momentum. On the other hand, not breaking through this resistance could result in additional consolidation or a retracement, highlighting the underlying risks associated with trading based on technical patterns. The existing configuration of the cup and handle pattern in Bitcoin indicates a favorable technical outlook for bullish investors. Projections suggest possible price targets ranging from $110,000 to $130,000. However, it is essential for market participants to exercise caution by closely observing critical resistance levels and overall market conditions that may impact Bitcoin's path forward. Analyzing this technical framework provides critical insights into Bitcoin's price trajectory. However, it is essential for investors to incorporate risk management and market volatility as fundamental elements of their trading approach. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.